half our family's wealth is in Berkshire Hathaway. Who is actually going to own the voting control? Is it going to be institutions, BlackRock? Are they eventually going to get their way with the ESG?
Well, you're thinking very well. And the interesting thing is the big aggregations look like, of course, they'd be in index funds. But what index funds want is they want a world in which society doesn't get upset with them about the fact they've got all the voting power. And I would say in the last year or two, it's looked like a better idea for them not quite to get as, what was the phrase that Charlie used?
They backed off a lot.
Yeah, they backed off a lot. And it's in their interest to back off. And interestingly enough, in looking at money management, the game is not performance, it's assets under management. And index funds produce a tiny, tiny, tiny fee on assets under management because it was pioneered by Vanguard, and when it became successful, it was very easy to replicate. Not so easy, but I mean, it was inevitable to be copied. But it came with a management fee of 2 basis points. So what people that have offered index funds would really like is you to buy their other funds or let them manage money in some other way so that they get a higher fee on assets under management, which of course is exactly why the index fund was invented in the first place. But so it's not a lost leader, but it is a way to pull money in, and then you hope that people ignore what was said by what's his name, that Jack Bogle. They ignore him, and essentially they give up the idea, and that we'll offer you a fund that does this in India, and we'll offer you another fund that does that, and of course those management fees are higher. So they're really counterselling the idea that John Bogle came along with. But in the process, they have achieved a lot of votes, and that was fun for a while. But the last thing in the world they want to do is have Washington or the American public decide that they're throwing around their weight too much. So they're tending to back off now. If you figure out where their self-interest is, you can judge where their behavior is going to go. Charlie, you want to defend them?
No, you can swear what you just said. You're totally right on everything.
Well, in that case, I won't ask anybody else.
The only real way to see how someone is going to do when running a company is to let them run it. This wise statement now applies to Berkshire. Once the second men are running Berkshire, what would you advise owners of Berkshire to watch for? Specifically, what actions, if taken, should give us concern?
Well, I think I would have some comfort in the fact that 99% of my net worth is in that company. So I probably got a stronger interest in it. And perhaps $100 billion or more of philanthropy will be affected by it. But I would say that I don't have a second choice. I mean, it is that tough to find, but I've also seen Greg in action, and I feel 100% comfortable. And like I say, I don't know. Something happened to Greg. I would tell the directors, they have a problem, and they won't. I don't have anybody to name, and if they put somebody in, Berkshire on automatic pilot can work extremely well for a long time. I mean, it isn't like the businesses go away or anything of the sort. And you can't. It's hard to judge successor management in a really good business, because if they don't show up at the office, it'll keep working for a long time. And maybe that lack of useful input may show itself in 5 years. I mean, it may go a long, long, long time. And how are the shareholders advised by a bunch of people that are concerned about whether you're meeting earnings projections or something, telling them whether the management's any good. It is very, very hard. It's very hard. I've been on the board of 20 companies. It's very hard to, if you ask me to rank the management of each one, it's very difficult to do because some are just better businesses than others. Some would be better off not managed hardly at all. Others really need help, but they got a lousy business. And Tom Murphy told me a long, long, long time ago, he said the secret of business is to buy a good business. And it's okay to inherit one too. And Greg is inheriting a good business, and I think he'll make it better. But I don't think it's easy to put any one of the next 10 nominees in and try and judge 3 years later whether they've done a good job or not. So it's going to be that'll be a very interesting job for the board. But it shouldn't listen to Wall Street on it. They've got the job. If they put somebody in, there's a surprise. We both go down on a plane, they put somebody in. They've got a real job in assessing that person because it'll depend on how good he or she is as a talker. It'll depend on, them courting Wall Street to be supportive of them, all kinds of things. And we've got some very good people on the board, but they would be challenged in that position, as would I, where I've been in that position in other companies where a very great leader has left, and on the way back from the funeral, nobody knows what to do exactly. Anticipating a few questions on banks, I decided we should start using bank language here to describe the and Charlie. The situation in banking is very similar to what it's always been in banking, that fear is contagious, always. And historically, sometimes the fear was justified, and sometimes it wasn't. My dad lost his job in 1931 because of a bank run, and they had a bank run on state banks. And the head of the Omaha National Bank said, well, we're a national bank, and they didn't have a run on the national banks. And of course, they both faced the same problem. So it used to be that if you saw people lining up at a bank, the proper response was to get into the line. And you'd always leave it. And the story is that Sidney Weinberg of Goldman Sachs, during one of the great bank runs back in 1907 or thereabouts, had a job as a runner at Goldman Sachs and asked his boss if he could take the week off. And the boss said, sure, not much is going on anyway. So he got in line at whether it was the Knickerbocker Trust or wherever. And as he got toward the front of the line, he sold his place in line to somebody. He didn't have an account at the bank, but that was an asset. And the banking system has changed so much over the years, and we did something enormously sensible, in my view. When we set up the FDIC, as many as 2,000 banks had failed in 1 year back after World War I. I mean, bank runs were just part of the picture. And if you have people that are worried about whether their money is safe in a bank and all trying to withdraw it, you can't run an economy very well. So the FDIC was very logical. It's got changed over the years some. But here we are in 2023, and we actually see the FDIC pay off at 100 cents on the dollar to everybody, or make it available on all demand deposits. And yet you still have people very worried about their periodically, geographically, all kinds of crazy ways. And that just shouldn't happen. So the messaging has been very poor. It's been poor by the politicians, who sometimes have an interest in having it poor. It's been poor by the agencies, and I'd say it's been poor by the press. I mean, you shouldn't have so many people that misunderstand the fact that although there may be a debt ceiling, it's going to get changed. Although there's a $250,000 limit on FDIC, the FDIC and the U.S. government and the American public have no interest in having a bank fail and have deposits actually lost by people. We had a demonstration project the weekend of Silicon Valley Bank, and the public is still confused. So it's something to have a law that was passed in a law that became effective in 1934, although modified in some ways, not understood about something as important as the banking system. I don't think the American public is that dumb. And I just, I made that offer over in Tokyo, incidentally, that I haven't heard from anybody that wants to take up my $1 million bet on whether the public will lose money if they have a demand deposit at a bank, no matter what the size. So that's the world we live in. It means that a lighted match can turn into a conflagration, or it can be blown out, and who knows what will happen. And we don't have any worry. We keep our money in cash and treasury bills at Berkshire because we keep $128 billion or whatever it was at the end of the quarter, and we want to be there if the banking system temporarily even gets stalled in some way. It shouldn't. I don't think it will, but I think it could. And I think that the incentives in bank regulation are so messed up, and so many people have an interest in having them messed up, that it's totally crazy. I mean, the Fannie Mae and Freddie Mac were doing 40% or so of the mortgage business in the United States. That is huge. They were regulated, just those two companies were regulated by some group, I forget what they called it, but they had 150 people that were in charge of just figuring out whether Freddie and Fannie were doing the right thing. Well, I could have done it. Charlie could have done it. And I'm not sure they needed an assistant even to do it. But the incentives were all wrong. And Freddie and Fannie, which were doing fine in August or apparently doing fine in July and August of 2008, were put into conservatorship, early in September. And the things that followed from that were just incredible. So there are second order and third order and fourth order effects that are somewhat unpredictable as to what they will be and the sequence and all that. But things change. And if people think that deposits are sticky anymore, they're just living in a different era. You press a button. You don't have to get in a line and wait for days and have the teller counting out the money slowly in gold so that you hope the line goes away. You can have a run in a few seconds. So the way it hasn't been addressed properly is a problem, and who knows where it leads.